Hey everybody, welcome to your mortgage market weekend review for the week of January 23rd, 2023. And oh, what a week it was. We started off Monday with MBS 5.5s being off 23 basis points. Supply was the name of the game so far in the morning. Bonds drifting weaker in the overnight session as European supply pushed EU yields higher. In the first hour of domestic trading, a slew of new corporate bond announcements was putting upward pressure on yields domestically. The index of U.S. leading economic indicators declined again in December, following a decline in November. The U.S. LEI fell sharply again in December, continuing to signal recession in the U.S. economy in the near term. Overall economic activity is likely to turn negative in the coming quarters before picking up again in the final quarter of 2023. Basically, the labor market and consumption are the only things holding up the economy at this moment. Fed funds futures are a lock for a 25 basis point hike next week. 25 basis point hike would put Fed funds at a target rate of 4.5 to 4.75, and the March futures see another 25 basis point hike, putting it in around 5. The May and June foresee a 33% chance of another 25 basis points. The street estimate for quarter 4 GDP is 2.7%, which is pretty robust, but the Atlanta Fed GDP now estimate is for 3.5. Both seem very high given all the things going on in the economy, and the ISM numbers showing contraction in manufacturing and services. Maybe some of this is inventory build, which will have an effect of borrowing growth from quarter 1. There's also a lot of news going around about the new LLPA matrices coming out. So here is a pretty cool chart that was done by Chris Maloney over at Bank of Oklahoma, or at least was reported by him. This shows the changes. So it's the change in the LLPA grids for purchases. So this shows that basically lower FICO scores, higher LTVs are going to get much better. The hits for those lower FICO scores and higher LTVs are going to lessen, while higher FICOs and lower LTVs, so people that have more money, are going to be subsidizing those to help get people with lower credit scores and less money down into mortgages. Also, cash out grid is basically, this shows the changes for cash outs. So basically, cash outs are going to get a little bit cheaper for higher credit borrowers. So it goes the opposite direction for cash outs. Bonds responded to the glut of corporate issuance this morning. Higher oil prices and looming treasury auction cycle may have added to defensive strategies. Trading was also light. So at the end of the day, we were down 11 basis points, which puts us in at 101.23, which is just above that technical indicator of the 25-day moving average of 101.081, with a ceiling of 101.671, though we do have a convergence of 3 extra floors right below that line, so should be huge drops. Also heard for the second time, I don't have a source for this, but I've heard it said now 2 or 3 times that about 40% of loan officers have not renewed their license this year. So less people competing for business, go out and get those loans. I also got a post from our sponsor at WellThatMakesSense.com. So it's Monday Morning Influence with Jocko Willink. So Jocko Willink is a great author. He also trained and led a whole bunch of Navy SEALs. And he said, fight weak emotions with the power of logic. Fight the weakness of logic, the power of emotion, and the balance of the two will find strength and tenacity to stay yourself. Tuesday turned into a pretty busy day, actually. The MBS 5.5 were down 16 basis points to start the day. Bonds had a mixed overnight session, holding flat in Asia, rallying into European hours and selling back to unchanged after the EU PMI data came out slightly stronger. The opening few minutes of domestic session saw a brief stint of buying right after the open, but those gains were quickly erased after the Philly Fed data. The January Philadelphia Fed non-manufacturing index rose to negative 6.5. Yes, I said it rose to a negative number. This gauge of regional business activity was negative 12.8 in December. New orders rose to 10.8 from negative 2.1, and inventories rose to 6.5 from negative 2.6. The private sector continues to contract according to the flash PMI index. The U.S. economy has started 2023 with a disappointingly soft note, with business activity contracting sharply again in January, although moderating compared to December. The rate of decline is amongst the steepest seen since the global financial crisis, reflecting falling activity across both manufacturing and services. The worry is that not only has the survey indicated a downturn in economic activity to start the year, but the rate of input cost inflation has accelerated into the new year, linked in part to upward wage pressures, which could encourage further aggressive tightening to Fed monetary policy. So this is one of those news items where bad news is good news because we have to have this happen in order to stifle inflation. About 13% of adults plan on buying a new home, a decrease from 15% in the third quarter of 2022. According to research from the National Association of Home Builders, respondents are more interested in buying an existing home than a new one. The yield curve remains super inverted. The 1 month is 106 basis points below the 10-year. The 3 month is 120 basis points below the 10-year. The 1 year is 119 basis points below the 10-year, and the 2 year is 72 basis points below the 10-year. This is a very strong indicator of recession coming. Bonds took several opportunities to react to economic reports that don't typically merit much reaction today. We saw similar behavior early in January. It made good sense at a time when the markets were extra hungry for every tidbit of economic guidance. After all, everyone is waiting to see if inflation is really defeated, and the soft landing might be from the Fed's inflation tightening efforts. They need to give up hope of that, if you ask me. Buyers are ultimately ready to buy as soon as data-driven selling pushed yields back to yesterday's highs. So at the end of the day, we ended up being at 101.34. So 101.34, which puts us right underneath that 38.2% Fibonacci line, and in an ever-tightening range with four different lines converging as a floor. Also got data that loans and forbearance were flat at 0.7% according to the MBA. Fannie and Freddie loans were at 0.31%, and Ginnie loans were 1.35%. So you look at that and you say Ginnie loans at 1.45% is still really low, but it's important to note that it's almost 5 times that of Fannie Freddie loans, which impacts the bond market and servicing values. We also got a post from our sponsor at WellThatMakesSense.com from Traction. So if you have goals that are important to you this year, which you should have, check out these posts on Traction, because Traction is the best operating system for setting up your year to achieve those goals. In terms of volume, not much to report on Wednesday. UMBS 5.5 were up 6 basis points early. Not much, but on the good side of things for once, bonds were flat to slightly weaker in Asia, but rallied in European bonds after 3 a.m. on a combination of economic and inflation data. In the 8 to 8:30 time frame, there was some new selling pressure after several comments from an ECB official contributed to a bit more weakness. U.S. equity futures slumped on Wednesday as recent earnings reports from the like of Microsoft Corp fanned concerns about the health of corporate America, and investors grew wary of Berlin's decision to approve the re-export of German-made tanks to provoke an escalation in the Ukrainian war. In terms of economic data, mortgage applications were up 7% week over week. Lower rates helped boost refinance activity by 15%, but 15% more than jack shit is still jack shit. Today's only discernible intraday movement followed comments from the Bank of Canada's governor regarding the conditional nature of their rate hike pause. Even then, the move was mild and bonds quickly recovered. Strong 5-year Treasury auction helped to reinforce the recovery. At the end of the day, we're up 20 basis points at 101.55, which puts us right below that 38% Fibonacci retracement line, which is the bold red line right there in our graph. So we've been trading in this channel for quite a bit. Basically we've been running a channel between that Fibonacci and the 50-day moving average, which has been trending upward. So we have a very narrow band here, so hopefully there won't be tons of volatility. We are seeing financials increase provisions for credit losses. Capital One provision $2.4 billion, which is a big increase from 1.9 in quarter 3 and $388 million a year ago. Given Capital One's credit card exposure, this is a warning that the consumer might be facing some trouble. I think this is under provisioning. I think there's going to be a ton of credit card problems. In other consumer banking results, we saw increases in provisions from Ally and Synchrony as well. For Ally, provisions are back towards pre-pandemic levels. One bank that bucked the trend was Western Alliance, which provisioned only $3.1 million in credit losses in quarter 3, compared to $28.5 million in $3.1 million in quarter 4 versus $38.5 million in quarter 3. Easier printed than said. Asset quality remains robust and charge-offs are low. Given that Western Alliance Bank has heavy exposure to the mortgage industry, this result is encouraging. We also got news that homebuilder D.R. Horton announced earnings this morning that missed the street estimates. As earnings fell 13%, revenues were slightly positive. Net sales orders fell 38% and cancellation rate rose 28%. Backlog fell 46%. And then we get post number 8 on traction. This is from the book Traction by Gino Wickman, which is all about setting up your organization to achieve all of your goals in 2023, regardless of what these market reports say. And Thursday was a whole lot of data that didn't amount to much. MBS were down 6 basis points real early. Bonds were already moderately weaker overnight following a choppy selling in Europe. The economic data is not helping for obvious reasons, meaning that all 3 reports were stronger than expected. First one coming in was GDP. So GDP came in at 2.9% versus a 2.6 estimate. It was 3.2% previously. When you look around out there, it sure doesn't feel like GDP is growing that much. But apparently it is. Consumption rose 2.1%. There we go. Like I've been saying, people just keep spending money. Investment increased 1.4%, and government spending rose 3.7%. Yeah, that's what happens when you approve of a $1.7 trillion budget or whatever that was. Inventory build, particularly in the natural resource sector, was a driver for the increased GDP print. Housing services, house price appreciation, and owner equivalent rent pushed up GDP, while actual residential construction was a drag. The housing services component will fade into the background as home price appreciation stagnates. Jobless claims came in at 186,000 versus a 205,000 estimate. Just keep beating that number over and over again. It was 192 previously, so people are staying in their jobs, so they have more money to spend and keep that inflation high, apparently. Durable goods came in at 5.6 versus a 2.5 estimate. Wow, big beat there. Core durable goods came in at minus 0.2 on a minus 0.2 forecast. It was 0 previously. U.S. economy expanded at a healthy pace in the fourth quarter, though signs of slowing underlying demand mounted as the steepest interest rate hikes in a decades threatened growth this year. Personal consumption, the biggest part of the economy, climbed to a below forecast 2.1%. PCE price index, the Fed's preferred measure of inflation, rose 3.2% compared to 4.8% the prior quarter. It's supposed to be 2% on the year here. Excluding food and energy, the price index rose 3.9 versus 4.7. New home sales rose 2.3% month over month to a seasonally adjusted annual pace of 616,000 last month, according to the Census Bureau. This is down 26.6% on a year-over-year basis. We need more houses. They're just not building the houses people want. I don't know what's going on here. These builders are confounding. For the year, an estimated 644,000 homes were sold in 2022, which was 16.4% decline from 2021, or it could be just that people don't want to wait a year and a half to get into a home they buy. There were 416,000 homes for sale at the end of December, which represents a 9-month supply. Generally speaking, 6 months is considered a balanced market, so the builders have inventory to go. Maybe they'll get them into some reasonable prices. Thursday morning's economic data provided one of only 2 major opportunities for this week. Scheduled events to ruffle the bond market's feathers. Despite the trifecta of strong numbers, claims, GDP, durable goods, bonds were right back to pre-data levels in less than an hour. Granted, we closed slightly weaker, but a lot of that stuff had come from earlier in the day. This places all the more focus on next week's events, including both ISM reports, non-farm payrolls, central bank announcements from the Fed, Bank of England, and ECB. At the end of the day, we were down 19 basis points, ending up at 101.34. So that puts us right in the middle of this ever-consolidating range where we have the Fibonacci 38% retracement at 101.671, which has been holding real strong. And then basically the floor on that is the convergence of the 25 and 50-day moving averages right around 101.059. So it's kind of nice to have a little bit of stability. I know we want everything to get better. Before we can get better, we got to get some stability. Goldman Sachs came with some very dire news. The Goldman Sachs, they're Goldman Sachs. They know a lot of stuff. Sees a 2008 style decline in 4 cities, including Phoenix. Oh, man. Guess where I live? San Jose, San Diego, and Austin, Texas. The bank sees declines of around 25% for these MSAs. Note that such a decline would put them above pre-pandemic levels given the insane appreciation over the last 2 years. So it won't bring them down to 2008 levels, just meaning those places might see some gigantic drops. We also got a post from our sponsor at WellThatMakesSense.com. This is a 9th I believe is our last post from the great book Traction by Gino Wickman. If you have goals for this year, and you damn well should, Traction is your system for getting them accomplished this year. So this sets out the framework for your meetings, for working with your team and working with everybody to get your goals accomplished. Check it out on our sponsor at WellThatMakesSense.com. MBS were pretty flat, being down 5 basis points on the open on Friday. Bonds were slightly weaker overnight, with more of the losses being seen in Asian market hours versus European hours earlier in the week. Then we got the PCE numbers. Monthly core PCE came in at 0.3 on a 0.3 forecast, was 0.2 previously. Annual core PCE came in at 4.4 versus a 4.4 forecast, down from 4.7 previously, so it is improving a little bit. Incomes were 0.2 versus a 0.2 forecast. Spending was down 0.2 on a minus 0.1 forecast. Year-over-year change of 4.4% is the smallest rise since October of 2021. Even though there's a decline and inflation seems to be falling, inflation will remain a hot topic for Fed the rest of this year. This will likely remain above the Fed's target for the rest of the year, which means we're more likely to see a target rate near 5 or a little over 5. Goods inflation and supply chain issues seem to be a thing of the past. Remember back with the big chip shortage? Well, Intel is swimming in excess inventory. Commodities like lumber are back to pre-pandemic levels. Housing inflation will stop bumping up the inflation numbers during the summer. The final leg is incomes, which have been falling for 3 months. The Fed seems to have gotten a hold of inflation for the most part, and work is largely done. Does that mean prices will return to pre-pandemic levels? No, it does not. They will still stay high. Inflation of the past year means that prices have hit a new higher plateau and will likely stay around there for the most part. Pending home sales rose 2.5% in December after 6 straight months of declines. Year-over-year transactions are still down by a whopping 33.8%. That said, it looks like a nuclear winter for housing is pretty much over. The two parts most capable of surprising the market this week were the Thursday GDP and Friday's PCE. While it's always good to maintain some respect for potential surprises, we weren't looking for any major revelations, plus a combination of them second-tier nature and the fact that they came in close to consensus. The recent reports caused no real regret for those that hit the snooze button all week. In short, this week has been pretty much a snooze fest all in all. Next week will probably not be the case. On Tuesday, we get Case Shiller, which will be interesting, but probably not moving the market, but we did get the Chicago PMI and consumer confidence. Wednesday, we get the ADP jobs number, as well as some more PMI data and the FOMC rate decision. Most people are thinking it's going to go up a quarter. And then on Thursday, we get jobless claims as well as factory orders. And then on Friday, we'll get non-farm payrolls, and unemployment rate, and some more ISM information. So that will be a lot of information coming in next week. So if you have some time over the weekend, check out our common sources and influences, particularly our sponsor at WellThatMakesSense.com.